Hello, it's Paul and it's
Megan.
So it is.
And it's the ESPC Property Show.
It certainly is. And today
we've got David, Lauder and Lisa Bell from ESPC Mortgages to talk all about everything mortgages.
Absolutely. I mean, we covered a lot. Self-employed, employed, fixed rates, variable rates, and we get some really good nuggets. Again, we always believe we want to try and give you something a bit different, something you've not heard before, and I think there's a few little nuggets in the episode.
Yeah, absolutely. So if you are looking at remortgaging or buying for the first time, this is definitely an episode for you.
Absolutely. Here we go. Okay, welcome. This is the mortgage episode, working title.
Yes.
And today we have two fantastic guests with us. Would you like to introduce yourselves, friends of the show?
Yeah, I'm David, Lauder, mortgage advisor for many years with ESPC.
That's where I've seen you.
And I'm Lisa, also mortgage advisor with ESPC.
Great, and we're going to take another deep dive into the world of mortgages. And to kick things off, over to you, Megan.
Yeah, absolutely. So David, you were on our last mortgages episode at the start of the year. But since then, we've seen multiple base rate cuts from the Bank of England. So we wanted to kick off and ask, what's the biggest impact you've noticed on the mortgage market since then, and how have lenders been reacting since the base rate cuts?
So the lenders have been reacting really positively. It's been happy for us to say to our clients, good news rather as bad news. Typically, and the general trend was that every time we got a rate bulletin through from the lenders, which me and Lisa get regularly, it was generally a decrease. I think roughly round about March, April time, right through until a couple of weeks ago, that was the trend all the time. Normally you can get a mixed bag of sometimes it goes up, sometimes it goes down, but just a gradual decline, which, meant that when we were reviewing clients' mortgages, or equally from when we got an agreement in principle to when they actually bought, the terms were more favourable. So, it's been it's been a nice change after a turbulent time, so yes.
Yeah, so it's good to be able to give good news, I guess, isn't it? As you say, especially those coming towards the end of the fixed rate, because there was that period, wasn't it, when, go back a few years, we were all worried about coming off our fixed rates, and it was going the other way, and we were thinking, wow, are we going to see 5-6%? Well, all that's speculation's kind of gone for now. What are the average mortgage rates then that we're looking at right now for, say, a 2-year and a 5-year fixed? Where are we?
So we're round about 4.5% just now on average, depending on your loan to value. We're seeing interest rates slightly decrease and increase at the moment. We've seen lots of decreases over the past year. It's been great, but starting to sort of level out at that 4.5% at the moment.
And that's for 2 and for 5, is it?
Yeah, I mean, we're seeing up to around about 5%, depending on your loan to value. I mean, if you're putting down the minimum 5% deposit, you're likely to be near that 5% mark, but certainly around about 2.5%. There's not much difference between the 2 and 5 at the moment, is there?
Which is quite unusual. We normally see one's better as the other because the predictions are looking into the next 2-5 years. But I would agree with Lisa. I'd say they're quite priced quite equally together at the moment.
Yeah, and we were chatting before the start with me, Lisa, about you see a headline fixed rate, but then when you look into it, it's a fantastic deal if you're putting down 50% deposit or something. And let's be honest, how many of us have got 50% deposit on a property these days? Yeah,
or it comes along with a hefty product fee that you're also paying to the provider as well. So what is advertised as a lower interest rate or the cheapest deal isn't always the cheapest deal for you.
And the moral of the story is?
Check in with your mortgage advisor.
Here's the first segue.
So, we're talking about obviously different kind of levels of borrowing as well, David, like loan to values. With do lenders have different criteria for this? Or are they relaxing their criteria to try and get more customers?
Lenders have got different criteria for different things and they view things, and that's where, sorry to talk again, but mortgage broker can then basically look at towards your circumstances. In terms of, they'll have their own credit score thresholds, they'll have their own way they'll look at like different types of employment, so fixed term contractors, self-employed, employed, etc. But that's always been historical. I think the thing that's slightly changed positively in the last few months is that the lenders also use a stress test against what they'll lend you, and that's based on a rate that's a little bit higher than the rate they offer. But the good thing is, because the rates have been coming down, the stress test has been coming down as well. So you're finding now with your mortgage calculators, someone that was on the same salary 6 months ago to now, they can probably get a little bit more money.
Which is great. And it really goes on to the next question, really, about affordability. So I think if you follow that through, I guess potentially a first-time buyer has a little bit more buying power now than maybe they did 3 months, 6 months ago.
Yeah, absolutely. Like David says, because the stress test is slightly less, it's increasing borrowing capacity, but there's some good options out there. So Nationwide, for example, have what's called a helping hand scheme for first-time buyers. So for a sole applicant, if they earn over £30,000, or a joint applicant, if they earn a combination of 50,000, they can earn up to 6 times their income, depending on, of course, their outgoings, etc. as well. But it gives them that little bit of a stretch where they can potentially borrow a little bit more, which really helps when you have a sole applicant that just has that one income. Gives them that little boost in terms of their borrowing capacity.
Yeah. 6 times, but as you say, that's predicated on, if they've got lots of subscriptions, lots of PCPs and everything, it all comes into the affordability, doesn't it, I guess?
It does, but I mean, 6 times is a big sea of change from if in the last podcast, me and Paul would probably be saying, when we're on Paul DeMarco, would be saying 4 to 4.5 times. But with the right circumstances, now you're looking at 5 to 6 times.
Yeah.
But you've heard it said so many times, we're not going to get back to reckless lending here, are we?
No, we don't want to get back to reckless lending either, because that's why we ask for 5% deposits and 10% deposits, because not every location in the UK is like Edinburgh, where prices tend to typically go up. And if they go down, that's where you get into those
spiral.
That spiral,
Yeah. I mean, remember the 105% mortgages?
The Northern Rock mortgages, that takes you back.
Where they go?
Well, the sad thing about that, Paul, though, the lesson learned was that ended up being a lot of mortgage prisoners because you couldn't remortgage them elsewhere because they were in negative equity.
Yeah.
Because they were getting £15,000 worth of unsecured lending to help pay with things, which was just crazy when you think about it.
And the sad thing is, there's a great lending institution that just got caught up in a race in the end, didn't it? To be bigger and bigger and lend more and make the rates even more attractive.
Yeah,
and,
I think things are just a lot more regulated now, and also the FCA have got stricter rules, but for good reason.
Yeah,
for that exact reason,
absolutely.
And so, Lisa, you obviously mentioned there that that's kind of a scheme for first-time buyers. When we look at people who are maybe moving further up the ladder, David, is that something, is 6 times your salary something that you can consider if you're moving up to the next, a bigger property, or is it is it easier now to move up the ladder?
It's easier in some ways because if you use the analogy like the home reports, houses are going for closer to home report in general at the moment, so you're not having to bid as much over for like a house higher up the property ladder. But the flip side is you're also not maybe getting as much for your own house. So you've not taken as much equity with you to your next property. However, as Lisa highlighted, that can be sort of coupled with the fact that you could maybe get more of a mortgage on your borrowing to take care of this less profit you're getting on your own house. But in general, you're getting a little bit more house for your money as you're going up the property ladder, because what we are seeing is houses going closer to home report. A few years ago, particularly during COVID, I remember actually talking about myself here, if I'm being honest, right, is that it wasn't unusual to pay 10% over, and if 500,000, that's £50,000 that you've paid over just to get the house. And that's, we'll see it now and again now, but it's not generally reflected.
And have you seen anybody, I don't know if you guys will see it from your side, have you seen anybody who's going now to try and sell property that they maybe paid over and above for and struggling to see that return?
Well, yeah, there will be if you don't give that house enough time to grow as an investment. So I think you'll see particularly houses 1-2 years ago, they'll struggle to get the return they did if they paid over the valuation, and they're expecting that return, because even when we're doing product transfers, although it's not accurate, we get what's called a desktop valuation to use that decides the loan to value for rates. And I've seen, the desktop valuation, although it's not an expert valuation, to be lower than what the clients actually paid the first time, and it can be a body blow to the client, but you have to say to them, this is a computer valuation, it's to decide the interest rate, it's not like an insult to you, if that makes sense.
Yeah.
But
what happens in those situations if your desktop valuation comes back at remortgage time and it's, it's less than...
You'll just go into a certain banding of rate that you'll be eligible for, which is called the loan to value, and that'll determine the rate, because that's all the desktop valuation really the purpose is. If the client feels strongly enough because they've installed a bathroom or a kitchen or whatever, you can, with some lenders, do a challenge, which can be free or it can be costly, but you have to put the justification and the evidence to show why you think it's worth what it is, because it's a little bit over head over heart. You kind of just because it's your house, it doesn't mean it's worth more because of what you've done to it.
Yeah.
Yeah, it's difficult, isn't it? As you say, at least you do have the right to appeal, but I guess they're going to look at the algorithm and the prices based on, the bigger picture, aren't they, really? Okay, we've sort of touched on fixed rates, those about to enter one, but what about those coming to the end of it? We've had those discussions on the show many a time, haven't we, Megan? People coming towards the end of it, towards that sort of 6 months out or wherever. Any advice to people where they can see maybe the rate's going to come to the end of the year or soon? What would you be saying to them right now?
Start reviewing their options early. So most lenders will now offer you around about 3 months prior to your existing rate ending to start reviewing your options. So if you've got a broker like ourselves, they can review your options with your current provider and compare that to the rest of the market. Remortgage options are pretty strong right now in comparison to previous years. So it might be best remortgaging elsewhere, but certainly start looking at your options early. Generally, current providers might allow you to lock in now, so you've got that peace of mind, and then potentially take advantage if rates decrease prior to your existing rate ending. So you've got that peace of mind that you've locked in case rates go up, but then you've got the possibility of taking advantage again if they decrease before that.
So in some ways you're almost saying that's it at its worst if you lock in.
Safety net.
And it can only go, so it's not going to go any higher, but potentially could go lower, and we've got 3 more interest rate reviews coming this year, so...
Yeah, that's a really good thing Lisa's highlighted there. If you do it 3 months in advance and they stay with their same lender and you lock in the rate now, you've still got another 2-month window with that lender to review it. So it's a really good tool.
I think it's been mindful as well, the sort of time frame it takes to either change your rate with your existing provider or remortgage elsewhere. The sort of time frames for that, we say remortgage 6 to 8 weeks. With your existing provider can be a bit sooner than that, but just bear that in mind, because a lot of the time it's not just a case of you can look at it the week before that ends and secure something in.
Go early.
Yeah, go early.
Yeah.
And I guess we have mentioned, obviously, maybe people coming to the end of a 2-year deal, it'll probably be good news for them because the base rates come down, but those maybe on the end of a 5-year rate are actually seeing that it's it's still having a jump up.
What you got in 2020?
Well, I know because I've won a 5-year deal, so and it's in the ones. So that's I'm preparing myself for that next year. So
paid $50,000 over the asking price for
exactly. But that's a great point, Megan. Though you're absolutely right. It's not, even though rates are very favourable at the moment. For most, there is some people that are still on even more favourable terms.
Yeah. Oh no, I've got friends that are
I can imagine
a bit worried for 2026.
Yeah,
but
right there.
So something we also spoke about at the start of the year was kind of £1 million mortgages, high-end mortgages. How are they treated differently to make other kind of lending criteria? Do lenders approach them with kind of more special rules?
Fundamentally, they're treated the same. Same rules, same criteria. I think where they differ is that certainly anything over 500,000 you can deal with like a Premier team, and what that means is you're actually often being allowed to deal with an individual in a one-to-one basis, and the beauty of that is you can very quickly liaise with each other to give them all the documents that they require, highlight the strengths of the case. If there's anything quirky about it, particularly with self-employed cases where you need to highlight if they've had an unusual year where they've maybe spent a lot on machinery or anything to help grow the business, you're actually giving a good reason why maybe the profit isn't as high as what it was, but they can take a more common sense approach, I suppose, and a fairer approach, just as looking at as same in the box. The other thing as well, when it's high net worth, is your cost of living, council tax, gas, electricity, doesn't really dilute the borrowing as much as what it was for somebody on 30, 40, 50,000 pounds.
It's a percentage of his salary.
Percentage of salary.
Yeah.
So then you do, I've got a better chance of going to what Lisa's point is of the 5 or the 6 times income, because they have still a lot of net surplus income every month. So that again is a more common sense approach. Fundamentally still the same rules, still need to pass the credit score, still need to evidence your income in the same way. But yes, there is a bit of looseness more about what you can borrow, and also probably with certain banks a more personal touch, or how you look at the case.
Yeah. But it's not a question of self-certification. You can't just say I'm earning X. It's still stringent.
Absolutely not. The only thing you get close to self-certification, which is certainly not self-certification, but some lenders for self-employed will go for like an accountant certificate or an accountant's reference, which avoids often the need for multiple business accounts and tax returns and everything like that, because they're taking it for the professional who needs to be a chartered accountant. So that feels like it can just be a one-page document, which can feel a little bit light touch, but it's done by a professional.
Regulated professional, yeah. I mean, is there such a thing as for those that don't know, self-certification was very much you could sign a declaration saying you were earning X. Again, back in the days of
I'm laughing
lending.
at you, Paul, because I'm so happy that I've never done a self-certification mortgage.
What are the most common mistakes you see buyers making then in the current market? If there is a mistake, what is the one that they're making?
I'm sure David will agree with me. At the moment, the most common thing that we're seeing is people coming to us after they've put in an offer on a property. Okay. So they're not checking that they fit criteria, establishing their affordability first that we would typically recommend. They're going off and making an offer and then coming to us to go through that process. So they might not be able to borrow as much as they need to buy the house because they've not reviewed that beforehand. And we just feel that that's a pretty common pattern now.
It's a very common pattern, and it's a bit stressful in a way because you need to do everything quickly, and it's a bit frustrating in a way because you're wanting to, particularly first-time buyers, educate them on what life will look like, what the payments are, what the order of events are, but you're really needing to just cut to the chase.
To just
check, establish that comfortable affordability with them as well. So they're sort of having a stab in the dark without finding out how much it might cost them in a monthly repayment, how much they can actually borrow. So yeah, that's the sort of more common thing we're seeing at the moment.
And is that because people are using just online mortgage calculators and they're just taking that as the gospel and saying that's
What's that saying from Top Gun? You're writing checks, your body can't cash.
That's right. Yeah.
Not sure that quite works, but you get the point.
I think that also people, maybe it's just the way of life now, but I don't think people seem as motivated to do the groundwork unless they absolutely have to.
Yeah.
If that makes sense.
But these are big life-changing decisions. You know, this is probably one of the biggest decisions you make in your life, isn't it? And it's a big commitment, isn't it? You know, you commit yourself to a long-term, I mean, what, 25, 30 years? What's the average these days?
Probably near 30 years
35
for first-time
seems
buyers.
to be the average for first-time buyers at the moment, yeah.
It's so easy to get caught up in the excitement of the offer's over. But as you say, just knowing your limit and knowing where you can go to and what you're comfortable going to ahead of time.
This is where the issues arise because particularly first-time buyers might not quite understand the process for offering over, how that affects their deposit. If they've ran a sort of rough calculation online, they might have used average figures, which even the slightest pound out can make the biggest bit difference in terms of your affordability and how much you can borrow. So that's what we're seeing the most of.
Yeah, it's a shame as well because when they're going and seeing a house on a Sunday without doing the groundwork, they can't translate in their mind that's what a monthly payment's going to look like and that's what my life is going to have to change or not change, where it then would make them much more feel comfortable about the offer that they were putting in because they're doing everything blind. So then it can become a nasty surprise or not, and there's just a mad rush from everybody to try and get caught up to where you need to get caught up to.
And I think that mistake of you know, you go offers over, you go £5,000 or £10,000 over. Well, you're finding that because the lender's going to look at the mortgage valuation, aren't they? They're looking at the valuation in the whole report. So it's important. These are fundamental things that you've got to get right.
Absolutely.
Yeah, and you're right, David, about the monthly affordability. It's not just that mortgage payment at the end of the month. It's your council tax, it's your bills, it's, you know, factor fees potentially for flats and things like that.
Yeah, I mean, we're lucky we've got a detailed fact find that has it's got 2 columns. One is your current column, so how you're going about your life now, but one is your future column, and that we fill that in before they buy to show what indicative payments, what life will look like, and what, if any, changes needs to happen, holidays, clothes, food, entertainment, because amazingly, most of the time, they are surprised how well the quality of life can still be, rather as not be. So it's actually, it's good news because some of them think, oh my God, my life's going to end here. So yeah, absolutely.
And so what is, leading on from that, so rather than a mistake, what's the kind of myth around mortgages that you would want to bust for anyone listening?
I think I think people are just intimidated by the word mortgage, and they think that, oh, I can't get a mortgage, there's no worth me trying, I'm not eligible for it, when actually lenders' doors are more open now than they've been in years. The affordability is all less, and as long as you're doing the basics, you know, credit score, you know, keep doing your payments on time every time, being disciplined with your money in terms of building up your deposit, having a regular income that you can evidence through pay slips, the glass is half full rather as half empty. They're here to help you. And if you've got a track record of paying rent, which is somebody else's mortgage, then that is a good evidence for the bank, because they're showing that you're paying a fixed monthly commitment every month, which in essence has got to be replaced by the mortgage.
Yeah. And is that mortgage scheme still available? What's that one where if the...
That was the one with Skipton.
Yeah.
It is available. I mean, it's not been that popular with our clients, which I don't know why.
What's to remind the listeners again of
there's a number of criteria. I think one of them is that you have to have been paying rent track record for 12 to 18 months.
Yeah.
And they won't lend you more than your mortgage payment will be no more than what your rent payment was.
Yeah.
But I think it's 100% mortgage as well, so you don't need a deposit for it.
Yeah.
And there's not many of them out there,
no, there isn't. And if you've been paying rent for a long time, then I can understand where Skipton are coming from here. So there is certain niche market that can be helped, definitely.
So there's a message there for tenants, isn't there?
Absolutely.
You know, if you think it's time for a change of rental property and you've paid your rent on time, kind of
Absolutely.
Particularly now that rents are increasing.
Absolutely, yeah.
It might be an option to look at.
Destiny, isn't it? If you buy, I think that's the difference, isn't it? You feel like Jaws. There's something about that feeling, isn't it?
Yeah, and I think you're right, David. I think people are kind of scared of the word mortgage. And I think I just remember, like, growing up, all you would hear is everyone older than me saying, "Oh, we just want to pay the mortgage off." And you just feel like, oh my God, it's this thing that hangs over you. But actually, it is. You're right, Paul. It's the thing that allows you to own your home and be able to.
It does. It's just overcoming that word and realising that actually it's just a standing order going in a different direction. It's got that word next to it.
The minute you get your property, you never forget that first time you close that door and that's yours. It's just a great feeling, isn't it? Okay, we've just touched on this a little earlier, but let's take a further look. Let's look ahead and let's talk about interest rates. We've made our predictions. We're close to being right, aren't we? So, how do you think mortgage market's going to look in the next sort of 25 into 26? Where do you see it? Where do you see the base rate?
Hoping some positive changes. If we could be around about sub 4%, that would be great. We've been seeing, like I said, slight increases at the moment because the swap rates are up for lenders. However, hopefully if we get a further cut, that'll have some positive impact.
Yeah. So you think we'll see one more cut this year?
One more potentially, yeah. I think it will be slow.
You're going two?
Okay.
You think two?
I don't. When I say that, I'm not saying it with any great confidence. But
it's hard to predict at the moment.
I think Lisa. I think one of us will be right because I think we will get one or two.
Yeah. I mean, interesting enough, I think this show goes out on the day of the
next.
next
so
thing.
today, we'll find out if the Bank of England have cut it again today. But
I think
Paul, you don't think
cautious as well?
Why is it wrong for me? I'll only tell you what the experts are saying, and they said there's a 96.5% chance based on article I read today that we won't see a cut, that we won't in this one. Then that leaves us 2 more reviews by the end of the year, then November.
Did they say anything about the rest of the year?
Yeah, I think there's still a view that we'll end up lower, and I think there's a view next year we might see 3% at some point, a whole 1% more from where we are now. But I mean, the variable is inflation, as we know, and inflation is higher in the UK than anyway. You can discuss the reasons for that all day long, but that's the reality. And I think the Bank of England has to be careful because they need growth, but equally, we don't want rampant inflation because that's not going to be good for anyone. So it's a real balancing act, but I think we'll see one more cut. Hope so. That was our bet, wasn't it? 3.75. So we'll see.
So final question, guys. If someone is listening to this and they're thinking about moving or buying their first home or moving house in the next 12 months, what would be the one piece of advice you'd want to give them?
Just prepare. So, and what I mean by prepare is, sounds boring, but continue to save money, establish yourself at your address with all your correspondence, pay on time, everything, and be able to evidence like everything that you do. So payslips, what you earn, bank statements, how you go about your business, savings, which is another thing, is if you're building up your savings, make sure you've got a trail of that because the banks will want to see a trail of where that money is. But just prepared to put yourself in as strong a position as possible.
And it's interesting because I think last time we had you guys in and we were talking about, when you pay like car insurance over 12 months, then that's seen as credit. We were like, ooh, or something like. So again, I suppose there's that decision to be made every time, isn't it? About how much credit am I accumulating versus using a bit of your savings to just pay the thing. And again, it's a balancing act, I would imagine.
Yeah, and I mean, obviously we're going to say this, but I mean, liaise with a mortgage broker, even if you are 6-12 months down the line, because those little hints and tips is part of what we can add.
Yeah.
But also, again, give you the little hints and tips about the things about credit file, being on the voter roll, using a credit card and paying it off. Just all little snippets that gives you the best chance possible, so that you get good news when the time's appropriate.
Yep.
So if you're not where you need to be, we can get you to the place that you need to be before you potentially start looking. And touching back on what I said earlier, definitely start looking at your options and your affordability and establishing the unique criteria before you go out and fall in love with a house. Because we don't want to have to give you bad news and say, actually, you can't afford this house. We want you to leave happy. So yeah.
I think so. But as you said as well, don't write yourself off, because you just might be able to get a mortgage. And I think with affordability and the flexibility of lenders now, they are, just say they're open for business. It costs nothing to inquire and speak to people like yourselves, does it?
Absolutely. No, it is. I mean, you're taking care of your own future, rather as somebody else's.
Oh, well, that's the strap line, I think, Megan. Now is we'll take that. Thank you.
Yeah, thank you guys for coming on, and I'm sure we'll speak to you both in another episode soon.
No
Thanks
problem,
for having
pleasure. Yeah, thank you.
Cheers, guys.
Thank you.
Thanks.
I enjoyed that.
Yeah, it was really good. I think, as you say, we speak to these guys normally about once every 6 months, and I think we always learn something different from them.
I think we do, and I suppose the change for me was just the income multiples. That's 6 times.
Yeah.
I mean, when I was young, we used to say it was like 3 times your income, and now we're talking 6 times your income. But clearly affordability is still a key, but it does mean potentially it opens up other markets for people. We're not seeing reckless lending, but we are seeing the banks and building sites open for business for sure.
Yeah, and hopefully in the next few months we'll see a couple of more rate cuts, and so that'll just open up affordability even more.
Absolutely, and we can come on the show at the end of the year, Megan, and say we were right. You said 3.75 base rates all along.
Yeah.
And we got it right.
Yeah, hopefully.
But we're not there yet. We're still at 4, just for the avoidance of doubt, on the day we record this.
Yes. So if you enjoyed that episode, please remember to subscribe wherever you're watching or listening. And otherwise, we'll be back in a fortnight's time.
Yeah, we look forward to it. So thanks again for listening. It means a lot. And we will see you soon. Take care. Bye-bye.
Bye. The initial consultation with an ESPC Mortgages advisor is free and without obligation. Thereafter, ESPC Mortgages charges for mortgage advice are usually £395 or £345 for first-time buyers. Your home may be repossessed if you do not keep up repayments on a mortgage or other loans secured against it. ESPC UK Limited is an appointed representative of Lincoln Consultants Limited, which is authorised and regulated by the Financial Conduct Authority.